Engaging in the Inland Empire. News, politics, business, family, things to do, and so much more. Join us weekdays from 6 to 7 a.m. on KCAA 102.3 FM, 106.5 FM, and 1050 a.m. or on KCAAradio.com.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, as we always ask you to do, we're trying to solve problems, your problems. I know you got problems if you're looking for a mortgage right now because you're not quite sure who to believe, who to trust, where to go with your mortgage. Maybe you have a difficult situation that you're just not comfortable talking to, I don't know, a big bank at the corner. One of the reasons that, and we will talk about this upcoming in a couple of segments with the great guests we have coming on the show. Maggie Miller is one of the great guests who is a loan officer for Mortgage Capital. Dr. Jeannie Bertoli will be back again, and of course Alexis Young from Las Vegas, Nevada. All of them talking about solving problems, difficult problems, mundane problems, problems that you're going to have if you want to get a mortgage. And getting a mortgage right now, as I said, you're aware of what's going on in the economy. You're out there looking at what's happening at your job. You're wondering if it's time to quit what you're doing now and go get a better job or to hang on to what you have. If you're reading the tea leaves or reading the news or just paying attention to what's going on either in the newspaper or online or on your local television news, you understand that the economy is in a precarious state. The president continually tweeting about whether Jerome Powell, his Fed chair, is doing the right thing by raising rates. Short-term interest rates are at volatile stages right now, although what we did see last month as a result of what's going on with the 10-year note, with the 30-year note, and these are things that are sold by the Treasury, and they really predict and dictate what happens in the mortgage marketplace. We saw that the rates went down. Now, when rates go down, that usually means that the yield on the Treasuries has to go in a similar fashion, that the yield goes down. And if the yield goes down and the rates go down, it usually means that we've got an issue with the economy. Maybe you've been reading or seeing what's happening in China about our trade policy, about the trade barriers that they're trying to disarrest, meaning that some of the products that we make here in the U.S. are not sold easily down into the markets in China, and that bothers President Trump. It bothers a lot of us, but it also rocks the boat when we've got tariffs on Chinese products, and they in turn place tariffs on us. Industries that are affected, obviously the steel industry, obviously anybody selling cars, anybody who's selling corn, anybody selling soybeans or oil, all of these things which affect our lives daily and cause things to be more expensive here are obviously designed by the president to put tariffs on Chinese products, which they in turn put tariffs on our products, which drives the market insane. So the nervousness by which we see in that causes a lot of things to happen when people are looking for solutions of what to do when they're looking for places to put their money. And if you're just trying to figure this out, you're Joe or Josette, and you're working at your little job or your big job, wherever it is in your local economy, and you're just trying to get by on a daily basis, putting your kids in school, trying to drive home, trying to make sure that gas doesn't exceed $3.50 or $4 a year, a gallon. You're just trying to get by. You're not quite sure what it is. How are you going to figure out this mortgage market? How are you going to figure out who to go to, who to trust? Well, usually what happens in a situation where you're looking to buy a house, you're looking to get out there in the marketplace and say, okay, I'm ready, let's go. I'm confident that my job is okay, but I'm not that confident of who to talk to in the mortgage. You go to your friend, you go to a family member, you go to the real estate agent that's going to sell you your house, and you say, I want to get a mortgage, who do I go to? Now, everybody in our business, in the mortgage business, which I'm a part of, not only am I the voice here at the Mortgage Voice, but I'm also the broker at Malibu Funding, Inc., the sponsor for the show. So I appreciate them doing that and putting us on the air each and every week to try to help you all figure out what you're doing with your mortgage. But if you're looking for someone to talk to about your mortgage, we at our company, we're both a brokerage and a direct lender, and both of those things allow Malibu Funding to have a little bit of experience in helping people try to decide where to go and what to do. Having choice is one of the main things you have in any kind of capitalistic economy, which is what we try to do here in the U.S. Now, because the way the economy is going, last year was a consolidation of a lot of lenders. A lot of lenders went out of business last year. A lot of brokers also went out of business. That hurts choice. And when your choice is hurt, you definitely aren't going to get the best deal that you possibly can get. However, if you do want to get out there in the marketplace right now and talk to a number of different people, talk to the big bank at the corner, Wells City Chase, or any number of other incarnations of that. Maybe you belong to a credit union also in that same vein, or you want to talk to a mortgage banker, Malibu Funding. You want to talk to a mortgage broker. There's plenty of them out there. Did you know that most lenders who are big banks like Chase, Wells, Shells. That's a combination of Chase and Wells. Chase, Wells, Citi, all of these large banks push originations down to the lowest level on the brokerage side. Why is that? Because it's too difficult to originate, train, and keep staff available for a potential client. That is not in the banks, and they're all publicly traded, so they all have to watch what they're doing on a daily in terms of hiring and the amount of money that they spend each and every day. Did you also know that last year most major banks lost between $100 and $150 every loan they did? Well, that can't last. So if you're looking to expand the amount of loans you get, and I talk about this all the time. Why? Because it's interesting and important to know. The loan that you have is important. The question is, who's going to work hardest for you in the marketplace when you have a loan to give? You have big banks, which are public companies, which get their money basically from borrowing money against their stock price and also the revenue that they make on their daily grind of you. If you're in a bank, you know what that means, the fees they charge based on whatever you're doing at the bank, even if it's just having a bank account. Unless you have a balance of, $5,000 or more, they're going to charge you $25, $35 a month just to have that account. And each transaction you have, the different services, they also charge you. That's a way to make money. The other way, of course, is to do business. One of the ways they do business is make loans. But if you're losing $100 to $150 per loan, it doesn't make sense for you to continue to train and hire people for your staffing. So the layoffs at some of these lenders are going to come this year, and I'm talking about Chase and Wells. And by the way, I don't know, Daryl, I don't know if you heard this, Wells just got socked with another $900 or $500 million fine for stemming from opening false accounts in the last 2 years, as we've talked about it on many occasions.
Whatever they get, they deserve at this point, I think.
Well, this is what I'm saying. If you have that, and Bank of America went through the same thing, you are not going to find the best service in your loan because they're cutting services in order to pay for not only the fines that they have, but to maintain shareholder value by making sure that their losses are less on the loan side.
Well, plus they're going to push those losses back into the equation and recapture that from their clients.
They have to. And who are the clients?
Me, you.
Yeah, the people who have a bank account there. You're the people who are going to get a dollar raised in your whatever your monthly transaction costs are.
Yeah, there's a couple of people that were writing me checks on Wells. I'm not a Wells banker.
No, I'm not either. Not anymore. I used to be.
But I was walking into their branches to cash the checks that were coming from some of my clients.
Yeah, how much do they charge you?
About 10%.
Right, 10%. Think about that for a second. But yeah. So what I'm saying about this and why it's important, it's not to make Wells Fargo look bad. They're a great company, and they're trying to survive like all of us. But if you're looking for someone to be patient and understand and care for you as you would like it to have happen, it's probably under the squeeze of their financial difficulties not going to happen at institutions who have other things in mind when you walk in the door. They want to make sure that you have a checking account with them. They want to make sure that you have a credit card with them. And, oh, you came here for a loan? Well, let's do all that first, and then we'll get to your loan. It's a bundling of services and the charging that really costs you as a consumer. So not only does Wells and Chase and Citi and Bank of America push originations down to the broker level, why even go to them? You should go to a broker or somebody in the banking world, in the mortgage banking world, because they have more time, less overhead, and their interest in doing your loan right is way more than somebody at a bank who has other ulterior motives. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's our telephone number if you pick up the phone and give us a call. You know, on the show, we try to help people by giving them information about mortgages, about real estate. We certainly talk a lot about the economy, about what happens, about the amount of money in the system in order to lend out. Things are happening in the economy and worldwide economy, which is going to affect the availability of money in the upcoming year. We haven't said that in a while, simply because we've got a retrenchment by the Treasury on all things of printing money, which means they're not doing it as much as they used to. And the Fed is certainly responding to the inflationary pressures by raising rates. Although we may not see as many this year as we saw last year, we may not see any, as if I'm reading it right. All that affects your mortgage, the mortgage rates you're going to get, and the availability of funds. Certainly the shrinking loan market has hurt in terms of lessening the competition in the marketplace, which is not a good thing for you as a consumer. From the East Coast, one of our terrific loan officers, and she has a company called Mortgage Capital Resource, is Maggie Miller. Maggie, how are you today?
Good, Jeff. How are you?
I'm okay. Thank you very much. And thanks again for coming on the show. I always appreciate your opinions about what's happening in the market.
Sure, no problem.
Okay, so tell me, what is happening in your business? What's going on? What are you thinking about January 2019?
Actually, these last couple days have been phenomenal for me. I have taken on more purchases. Just took on a couple new ones today, people that I've done loans for in the past.
Great.
So things are actually moving. I mean, what I'm doing are things that are like a couple refis going to where they are a need. It's more so a need. I see somewhat of people just adjusting to the fact of the rates. Actually, quite honestly, I don't really think the rates are that bad.
No, they're not. As a matter of fact, they went down a little bit last week of last year. So it was down to 4.75 again for a 30-year fixed as opposed to 5.25. So, yeah, I don't know what's happening in terms of the rates, but it's volatile. It's up and down. And so what are you telling your clients?
Well, I've seen 4.5 today.
Okay.
I'm sorry, what was that, Jeff?
Just what are you telling your clients? You tell them to float, lock? What's the strategy?
Lock, absolutely lock.
Right.
It's not worth jeopardizing an eighth or a quarter. It's just one of these things where, again, it's a need, and it's one of these things where you don't want to risk it, not for that. You know, just my clients actually have been very, very fortunate. The ones that I do work with, they take what I say and they do it. So I'm very fortunate on that.
You've got experience in this business through many kinds of markets, ups and downs, and also personal experience, which you can bring some empathetic hearing or ear to whatever issues or problems that the borrower might have. So I think that really gives you a leg up on a lot of the competition out there.
Yeah, I feel, Jeff, honestly, the customers that I'm working with are a perfect example of one that has this huge judgment on their title, that they went to somebody else and they just threw their hands up and said, deal with it and get it fixed and come back when you got it fixed. And it's not one of those things where you just do. And you just take those extra steps, you go the extra mile, and you are constantly in their face, shall I say, and all over it. And that's what they need. They need the hand-holding. They need somebody that's going to push and shove them to get to that end result, and that's closing their loans. And so my clients actually have been very fortunate, but I consider myself maybe, to some people, maybe a bit over the top, where I'm a bit pushy. Mm-hmm. But at the end of the day, I get the job done.
Right. I think what we see right now in the macro in lending in the U.S. is that most large banks or retail lenders, they're pushing all of their origination down to smaller shops, to mortgage brokers. And the reason is that they don't have the staff, the time, the energy, or the expertise, or the patience to deal with borrowers that you just described. And
No, and just to give you a heads up, this judgment is coming off, and it's because going that extra step and contacting the bank involved and proving through various channels, proving that this is not valid and you can't have your cake and eat it too, and pass it off as a
legitimate lien, right?
Yeah, a write-off from 2012 on their taxes and try to collect on it. So it's just one of these things that has just been sitting there, and they've been putting it off, and so finally it's worked to my advantage, and it's got me to be able to do 2 loans. Now,
you mentioned that you were doing a lot more purchase, right? Or is this, okay. And in the purchase market, do you find that the realtors who are involved in the deal, are they more anxious today or less anxious than they've always been, or is it about the same?
I think they're more anxious. Right. Last year I think they were a little bit laid back, but I'm finding in dealing with a couple of my agents today, one in particular is a past client I've done a refi for, and his girlfriend, she's a real estate agent up in Tracy, California, and I've been going back and forth with her for the last couple hours, back and forth, and they want to sell both their homes and buy this one, and then, like I said, I've got another one selling, it's a past client again who's trusted me over the years. A couple years ago did a refi, now they sold, and now they're buying another place, and so I just keep in their face. But the realtors, they're obviously loyal to they're keeping loyal to their people in the past. Mm-hmm. But at the same time, if you like the realtors I work with, they feel comfortable with me. They know if it's a hard deal, I'll get it done. Mm-hmm. And most of the deals out there require, in my opinion, I think, of course, right. The brokers have a better advantage than your direct lenders. You're walking into a bank. We just have in my opinion, the edge. We can go ahead and we can do the deals and work those deals that the other places won't.
What I've noticed with the realtors in general is that because out here on the West Coast, and I assume also on the East Coast, what you get is nervousness about whether the deal will close.
Absolutely. Absolutely.
And I was going
to say that.
Yeah, and that stems from either a lack of knowledge of the way that lending is currently, because as we all know, rates went up last year, a point from the year before, which is a big deal for a lot of people trying to squeeze every dollar into the mortgage payment. But go on, I'm sorry.
I was going to say, you're absolutely right, Jeff. There is a big nervousness on the agent's part, because I think that again falls to where if they don't have a regular loan person that they can rely on that will get it done, they don't have that confidence level to know that their commission is for sure.
Yeah, and I think at the root of it, isn't that really what it's about? Look, we all want to get paid, and as the broker over at Malibu Funding, as you know, that's who I work for and who sponsors this show. So for them, when I put on that hat, I get calls 3 or 5 a week, and I never used to get this. And it's been probably the last 6-8 months of very nervous realtors who want to be in control of a situation that is controlless. This lending world is not science. It is an art form of trying to make sure that the documentation for each and every borrower is specific to the product we're trying to get them. So it's not cookie cutter. You want cookie cutter? Go to Wells Fargo, go to Bank of America, go to Citibank.
Yep, and to be honest with you, Jeff, let me interject there real quick. I think the key to all of this is, the fact is, you got the nervous realtors. I think the key is what's the word I'm looking for? where you're trying to think of the word to best describe loyal to your banks, loyal to your, if you've got a great processor, which I do, and you've got certain banks that you deal with. I mean, I can't tell you how many people I get solicitations from other various, lending institutions to send my deal over there. But to be honest with you, I'm going to send it to where I know it's going to get done, and because of that, I get the better service.
No, and I think that's true. And I think when we're talking to clients, borrowers, people who want to either refi or purchase, having them understand that the relationship that you as a broker bring to the deal is better than saying, name brand big bank, right? Because
Absolutely.
Name brand,
without a doubt.
because you get to spend the time, and you have built relationships, and those relationships are what pays off when you really need something done.
You bet. And it happens for me all the time. I do ask for favors, or I do ask for little things, and it happens for me because I am loyal. I'm not going to go ahead and give one deal here, one deal there. To be honest with you, I don't want to keep track of that. I want to know there's 2 or 3 that I send to, and I know it's just going to get done, and there's the loyalty there.
Maggie, shout out your phone number for people who want a terrific loan officer.
Sure. It's 805-527-5877.
And you lend all over the U.S., and I want to urge people, if they're looking for someone to talk to, please give Maggie a call. Maggie, I appreciate you coming on the show once again.
You're very welcome, Jeff. Thank you very much.
Thank you, too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I am Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number here. It is 2019. That's correct. What are you doing for your business life? What are you doing in the real estate world? And are you planning to get a mortgage this year? The show is going to focus on both the rates that you're going to be expecting to get, or maybe guessing to get, some of the availability of properties, and other things that make real estate fun, interesting, exciting, and always changing. We are here in Southern California, KMET, KCAA, Northern California at K Tahoe. We hope to bring on some new affiliates this year. And again, I'm Jeff Barton, and thanks for listening to the show. We are trying to bring to you great guests as always. So we went back into the archives to bring a guest that provides to us both some professional information as well as some personal information. She's both a doctor as well as an investor, and that's Dr. Jeannie Bertoli, our resident expert on many things psychological as well as investment. Dr. Bertoli, how are you?
Hi, Jeff. Happy New Year to you.
And Happy New Year to you, too. Thanks very much for coming on the show. I do appreciate it. I like
to think of myself as a friend of the show.
Friend of the show, like friend of the court. You're a friend of the show. We'll wait for your amicus brief about the next section. And anyway, a couple of things about what you're doing. You'd mentioned to me off air a little bit about some of the investments you're doing, about paying off a mortgage. Let's get to that right away. What is it exactly that you are doing this year? And congratulations if I heard you right. Okay,
great. So I bought my 7th property just over 2 years ago, and I got a 30-year mortgage like most people do, and I will pay it off this year when it is 2 years and 2 weeks into the payment plan. So I'm beyond excited, and that will mean that I own 6 properties outright.
Free and clear.
Free and clear.
Okay, and in that free and clear, they send you a remittance of your mortgage, and they clear it from the title of your property, and so anybody that's looking at you will see that obviously you are property rich. And you were talking a little, right? I think it's excellent.
Yeah, I can't wait.
I mean, I think there are many people in the audience who listen to the show who are always trying to figure out a way to get to where you are. Tell us in, a minute, how did you do it all? And how?
I think part of it, I had my first property was a really expensive condo in Washington, D.C., and then the next 5 that I bought were middle of the country, very low entry points. And if I were to start all over again, I would start with the lower price points and get those early wins, get those paid off, get the second one, get the third one. So the next 5 I bought were very low price points, and then I went back up to between a medium and a high price point for my 7th property. So I think, really be encouraging of yourself. start small, start where you can feel the wind, get that one rented out, move on to the next one.
Okay, management. How do you handle that?
I have my 5 properties are in one building
Okay.
in St. Louis.
Okay.
And so I have one of my tenants functioning as a property manager, and she takes care of them all. They have a property manager on site, and I just give her a reduction in rent as payment.
Okay, so that makes it pretty simple then. You don't have to travel all over, and the maintenance in a building like that is probably minimal. I think it's a new building, right?
It was newly remodeled, but I also want to tell you that my favorite thing that I do is I keep a warranty. I use AHS, but by having a warranty company, it means I will never have thousands of dollars of appliances or anything else.
Now,
it's very inexpensive.
Do you do that individually on each unit, or do you do kind of a master policy? How does that work?
They don't do a master policy.
I see.
They only do individuals.
I see, and it's pretty reasonable, right? What is it, a couple $100 a year?
No, it's about $40 a month.
I see, per property.
Per property.
Okay, but the rent probably covers that. And these properties,
yes.
as you said, are at the medium to low point in terms of, getting in and purchasing that.
These are at the super low.
I see.
I found something that was super undervalued, but that's something that I could not do on the coast in California or Washington, D.C.
Right.
It had to be sort of middle of the country, and there's lots of places middle of the country where the economy has left people out where they didn't want to buy a new house. So there's lots of houses that are at that low to medium point. But I'm telling you, I would really suggest people get that win at the lowest point that they feel comfortable.
Yeah, I agree with you. And I also think that what we've got here on both coasts is a very nervous market. Where is it like you are? How is it down there?
Where I am is a very comfortable place, so it's got very low inventory, and the prices shot up. In my complex, my neighborhood, they've gone up about $30,000 a property in the last 18 months.
Oh, yeah, that's excellent. Well, I don't know what your purchase price was, but $30,000 is still $30,000, right?
Oh, yeah, I got in low. I feel so lucky because 1 year later, I would have been really paying the price.
Yeah, exactly right. Okay, so psychologically, as a professional, how do you advise people when it's a nervous market? And I think I could classify what's going to happen in the first quarter to maybe halfway through the year is a feeling out process of what's going on with the economy as a whole and what's going on with real estate prices as well as mortgage rates.
So we're talking about investors or people who want to live in their home? Yeah,
I think both. I think as an investor, obviously you're looking for the best opportunities. So most people have a track record and have a good sense of what the market's doing and buy at the right price. But a lot of people who are getting into the market now or trying to buy their first home or even, move up or move down, they get nervous because nobody wants to buy when, you're not quite sure what's happening, either going up or down.
So one thing I think is really important from a psychological perspective is to understand your comfort with risk. Mm-hmm. I really think that real estate is among the lowest risk potential investments that you could possibly have. So I would combine your comfort with risk, and do something that isn't going to feel so scary. Like maybe you want to feel a little bit excited/nervous, but don't put yourself in a position where you're feeling terrified every month, because that's just no way to live. Mm-hmm. And I think the other thing is to buy in a place where you can see that there's a good rental market, because knowing that rent is going to come in or that you could replace that one tenant with the next tenant is really the ease of mind that from a psychological perspective, I just think it's crucial not to set yourself up for failure.
Right.
And that setup for success is knowing, you know what, I may not get top rent or I may not be in D.C. or L.A., but you know what? I've got my little thing going. I got my little, train chugging along.
Yeah, you know what? That's a good point. Having security, knowing that you've, like, for instance, you were able to, in a very short time, pay off several mortgages. Now you have cash flow in the door. You have taxes, and that's it. Management costs and whatever maintenance you got to do, but the rest of it is pretty much gravy.
Yes. And I would say this, that most people, I think, when they think in terms of their investment properties, don't factor in, I have HOA plus taxes, plus maintenance, plus property manager. So it's not like I have the highest ROI just in terms of rental. You've got to factor in all those things to recognize what is your true profit.
Okay, you talked a little about how do you leverage the equity that's sitting in a property that you own free and clear.
I mean, that's really my question to you. Is
Right.
I now will own 6 properties free and clear. Let's say they're worth $750,000
Yeah.
total.
Yeah.
So how can I, instead of using cash to buy my next property, how can I leverage these as collateral in some way?
That's right. I mean, the collateral, either individually or collectively in a blanket type of loan, it would be in terms of leaning the property, right? I mean, that's how you would have to do it. So therefore, you would have to encumber the properties once again in order to purchase something else. I don't know if that's something that you wanted to do. Everybody has a different strategy with which how to grow that particular business, and your business seems to be, or one of your things you're doing is to buy and hold, right? Waiting for the equity to rise and see what happens next.
Well, and actually, I want to hold mine forever. I want
Okay.
I want my rental income to be my income.
Right,
going
okay.
forward.
So then you have to look at the purchase and whether the leverage of your other properties calculates to where you want to be in 2, 3, 5 years. So if you're buying a house for $200,000-$300,000 that you have to leverage all your other properties, or a combination of all of them, how long is it going to take you to get out of the mortgage that you're going to encumber all these properties? And in that time, are you going to be able to be okay with having a mortgage of $200,000-$300,000?
So are you saying I would get a mortgage with my existing properties as collateral?
Correct. And you can do that either what they call a blanket loan, or use that as collateral for the new loan to purchase. Either you take the money out, or in the new loan to purchase, that's what you use as collateral rather than your income.
Okay. Is it possible to get a line of credit based on...
Yes, it is. If your properties are in LLCs, you could probably get a line of credit for that.
Okay. Do you know the percentages that one can get?
Usually, it really depends on the market and depends on the property. But those are something that you would go to a regular bank and get your equity line of credit. Bank of America, Wells Fargo, Chase, Barclays, Citizens, any of these large banks, that's what they're doing now. The smaller lenders and institutions aren't quite into the home equity line of credit. Listen, Dr. Bertoli, I'm up against it right here, and I got to go.
Alrighty.
I know, that was really quick. I know, I'm sorry.
One time.
I know.
Okay.
Hey, listen,
Another time.
I'm doing that Vegas show, so respond to the email I sent you if you can make it.
All right.
2
Thanks
weeks.
for inviting me.
You're welcome. Thank you very much. This has been Dr. Jeannie Bertoli. Really appreciate you coming on the show.
Bye.
Hi. Thank you very much. Bye. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Pick up the phone, give us a call, talk to us about what your needs are this year, January 2019. That's right, it is 19 years past the millennium date. Isn't that amazing? Think about that. If you're out there right now and you're wondering what the heck happened all the time, well, that time in the future is just around the corner. So if you're looking to make some decisions about your financial future, think about real estate purchase, think about rentals, think about commercial real estate. There are all kinds of cities and places where you can do well as well. And this show is pretty good at bringing people on who are from not here to give you an idea of what goes on outside of Los Angeles. I know we get very LA-centric in many times, and of course we're talking San Bernardino Riverside, we're talking about Indio, we're talking about San Bernardino, and of course Las Vegas, Nevada. And with us once again to talk about Las Vegas, Nevada is Alexis Young, who works for Smartway Acquisitions out in the Vegas market. Alexis, how are you?
I'm good. Thanks for having me back.
And thank you for being on. And how was the New Year? Did everything treat you well and looking good for this year?
New Year's. How about you?
Pretty well as well. As you know, we had a fire out where I was, and we got through the fire, barely. My house survived, and we survived, and now we're on to the next thing.
Right. Yeah. 2019 is already off and running for me. It's been pretty busy already this week.
Okay, so you're doing commercial as well as residential?
Yes.
Okay, tell us a little bit about what's happening in the Las Vegas market for those who would like to know.
So as of right now for Q4, we saw for residential sales for single-family homes that we've leveled off.
Okay.
And the median price is around $295,000. So we've kind of steadily stayed around that price range.
Right, for about 6 months, yep.
And our inventory has increased, but we're definitely not at a 6-month inventory. So we're not in a complete flip yet. So don't let the news fool you.
Right, okay.
But if I were you, I'd try to get in and get something while we are a little bit slow. Sellers that are on the market, they're starting to get a little antsy, and they would love to get some offers. And so if you've been thinking about it and you want to wait till after the new year, the time is now, because everybody kind of starts ramping up in the next couple of weeks. And then you're going to be in multiple offer situations all over again.
Do you see that happening in that area? I know across the country it's a little bit nervous because we're not quite sure where rates are going. We're not quite sure what the economy is going to do. I know that here on the West Coast it's a little bit nervous. How is it there? Are people happy,
Sure.
excited? What's going on?
Sure. So actually, that's a good point. So what we're seeing right now in the Las Vegas market is that the rental rates are rising.
Mm-hmm.
And I'm sure quite a few people know that the multifamily market in Las Vegas was really hot. We were number one last year, and we were going strong. We have a lot of Class A properties out there. There is a lot of buying and selling, and the new properties that have been built, they're around $2 up to $2.50 a square foot. And that's pretty expensive for
Right.
Vegas because a lot of people are on fixed incomes, and we're not getting that minimum wage increase. We weren't a part
Right.
of that.
Right.
So we're kind of struggling a little bit over here, and now the city is trying to implement affordable housing. And that's a big plus because we have seen an uptick in homeless population as well. And there's not a whole lot for people to go to. Our shelters are very limited.
Mm-hmm.
And LA, San Francisco, they have a lot more resources than we do here to help everyone. And so with that being said, I personally have quite a few off-market properties and multifamily, and they are affordable. And what I have right now, it's not exactly a Class A, but it's definitely a worthwhile investment because within the next coming few years, you know, with the election that will be coming up, and
Yep.
it will be flipping blue. I'm not either. I don't really care.
I don't care either.
Based on that and the economy, I don't really foresee things skyrocketing. I think there will be a downturn at some point in time.
Yep.
And if you're a savvy investor, you don't think with your emotions. You think about what's going to be stable. And what's going to be stable is cheaper investments for people that can afford it. So you need cheaper rental rates. Because if everybody loses their stability, their jobs, their investments, how are they going to afford to live? They're going to need somewhere where they can live comfortably with their families, and that's not going to be $2,000 a month for rent.
That's interesting. I know that Vegas, there's a lot of properties that have gone luxury, right, rental. But what is the base rent? Like you're traveling out to Vegas, you got a job working at one of the casinos or in construction, and you know, can you get a one-bedroom place for $600, $700, $800? Is that still doable?
So there are a few places on the northeast side of town.
Mm-hmm.
I wouldn't exactly recommend living there.
What says North Las Vegas?
Well, I can't say nothing will happen because
Right.
they are in some dangerous communities.
I see.
But they are in that price range. Everything is going up, and
Right.
so what used to be $550. It's now $750,
Right.
and what was $750, it's going up towards $1,000. So we're definitely seeing average $1,000 or more. Now luxury, we're seeing $1,200 at least for
Right.
600 square feet.
Wow, okay. So, yeah, I mean, Vegas has turned into, well, obviously it's not as expensive as some of the larger cities on the West Coast or the East Coast. But for Vegas,
Right.
that is a lot, that's very expensive. It wasn't too long ago where the average rent there was $600 a month for a one-bedroom.
Sure. And so if you want to compare, I know because I've been doing a lot of work in California as well. So if you want to compare the same type of studio, one bedrooms, they're going for $3,000
Right.
roughly in California,
Right.
and we're about half of that here. And so that's still pretty high here when people were paying $800 at one point in time.
That's right. And obviously the employment has to, you know, afford that. And people going to work every day have to understand that, you know, the rent that they signed this year is probably going to go up next year, especially if what you're saying is true, that we're going to have a, you know, a recession of sorts, but it's not going to be a hard, you know, fall. It's going to be what they call a soft landing, meaning that, yeah, there's going to be a difficult, maybe a soft recession. You know, you're going to see some layoffs, but for the most part, you're just going to see a flattening of prices rather than a huge reduction like we saw in 2008.
Sure, and I also think that certain people will be affected more than others, but I think that as a whole, everyone's just going to have to tighten up a little bit, and
Right.
some people just won't have that high standard of living anymore.
Yeah, no, I agree with that. Listen, can you shout out your phone number for those people who want a terrific real estate agent out there in the Vegas area?
Sure, it's 702-704-3135. And I also get off-market properties all over the country. So if you're interested, I'd love to hear from you. Please give me a call, or you can also email me as well.
Okay, Alexis, give us a 45-second snapshot of what's happening in commercial right now.
So right now, we're kind of seeing a little dip in the retail markets because, as you've probably heard, quite a few companies are moving elsewhere, especially from California, because the rent is so high over there, and we're seeing a lot more online shopping. And that's not any news to anyone. A lot of malls have been closing up. A lot of companies have been going under. They just can't handle the brick-and-mortar retail stores anymore. So that's one. And then we are also seeing a lot of development here in Las Vegas. We are expanding very rapidly, and we just covered multifamily. But we are expanding residentially as well, and with that comes with shopping, grocery shopping, for instance, and necessities. So that also is building out as well.
Alexis, thank you very much for coming on the show. I really appreciate it. This has been Alexis Young from Smartway Acquisitions. Thanks for doing this, and we'll do it again soon.
Sure, thank you.
Thank you
Have a
very
good
much.
day.
You too, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's our telephone number here. We have an email address, info@malibufunding.net. You can see me on YouTube. If you go to YouTube, dial in my channel, Jeff Barton, the real estate voice. We combine our Las Vegas and our radio show on YouTube. We got a YouTube channel and, have over 100 shows, probably more than that now. And appreciate it if you take a look at that. My Twitter handle @Jeff6493. Now, when you hear a radio show and the host does that, right, rattles off a whole bunch of things, it's not necessarily that we're expecting you to remember it. It's basically so I remember it, because I don't remember a lot. And I have to constantly remind myself, like with the rates. Today the rates were down a little bit, right? So I have to constantly say, okay, what are the rates today? It's not 2017, where I could tell you in 6 months from now what the rates are going to be, because it was predictable. The rates in the Janet Yellen Fed were easy to predict. Last year, not so much. We had 4 rate hikes by the Fed, Jerome Powell's Fed. We had the president, I guess, tweeting every other day about some problem or issue that we were having. We had an election. We have an economy which may or may not be in early recession stages. We're not quite sure. We have a stock market that did its worst year since 2008 last year. Now, granted, in 2008, we were at 15,000 and falling. Today, we're at 23,000. So it's a little bit different in terms of the actual numbers that we're seeing. But we have some similarities. So this year, 2019, let's make a prediction. Okay, Darrell, you ready to make some predictions?
Sure.
Okay, very good. My first prediction, the real estate market will remain constantly steady in terms of its availability of product. We will not see an overabundance, but we will not see a shortage either. Therefore, prices will probably go up, but not more than 3 to 4% this year. Prediction number 1.
Okay, I believe that.
You good
to be
with that?
true. Yeah, I'm good with that.
Okay.
I think what happened last year in the dip in the economy and in the rates was necessary to give people a sense that that can happen ultimately if trouble lies ahead, right?
Right.
So trouble was out there in the road. We didn't hit the deer. It moved across the road.
Right.
And so we have some comfort going forward that, hey, if there's another deer on the road, we know what to do to fix it.
Right.
But here's where it normally should be.
Right, I think.
Here's the 55 miles an hour. Here's the 60 miles an hour that we're going to move at, unless we have a problem, but we know how to slow down if we have to.
Yeah, I think that's right. I think what we experienced in 08 was unbelievable, right? So this year, because it's the first year that we're going to, probably in 2019, prediction number 2, we will see a slight recession this year, maybe going into next year, and it may happen in the second half of 2019. Now, what do I mean by a slight recession, and what is a recession? A recession simply means that you have 2 things going on in the economy. It grows or it shrinks. Okay, so if you get 4 quarters in a row, or is it 2 or 3? I think it's 4. If you get a year whereby the economy contracts, that's called a recession, which is why you could be in a recession already and not know about it, because you only have 2 quarters of a shrinking economy. So I think we're going to see GDP. Now, they were saying this year it grew at probably 3.25% to 3.5%. In 2018, rather. In 2019, we're going to see probably it shrink by 0.1%, 0.2%. That's what we call a mild recession, a soft recession. If we see that happening, you'll see unemployment tick up a little bit. I mean, we've got low unemployment now. But that's my prediction for my second prediction, which is we will see in the second half of this year a start of a recession which will last probably 12 to 18 months through the election of either the current president again or the next president. What do you think about that?
Well, I think that the thing that comes out of this administration presently is everything is either a disaster or it's the best ever, right?
Yes.
There does not seem to be any middle ground.
Yes.
And so either you're going to have something that's going to go up or go down, because being somewhere in the middle doesn't count anymore.
Let me ask you a question. We see a new Speaker of the House, Nancy Pelosi, who was the old Speaker of the House.
Right.
We see the potential of continued volatility fighting with the president.
It's going to continue as long as the Democrats are controlling the Congress.
Well, the House of Representatives,
right,
certainly.
House, right. And as long as the president is in place.
Yeah, and I think that's good for the country.
Well, it certainly keeps people on their toes, and it keeps people glued to the television to watch what's happening in politics, because up until fairly recently, people were somewhat disinterested.
Yeah, I think out here in the West Coast, that's absolutely true. And I think, the divide, and as a reflection of this, Fox News last month had its worst month in, 8 years. They were third in the television ratings for television news, behind CNN and MSNBC, which gives you an idea of where the conservatives went. They just left. They just don't watch anymore.
They abandoned the ship.
Right, and ever since Roger Ailes left Fox News and the kids took over, Rupert Murdoch's kids, the network has kind of, not really followed the traditional Sean Hannity route, and I think that reflects what's going on in the country. I say it's good simply because I think stalemate in government is good, and that means that you probably are going to see status quo. And I think that's a good thing, too. I don't want to see, the government closing is not a good thing, and we need to work that out somehow, because I think affecting 800,000 workers is going to hurt the real estate market, and it's going to hurt what we do every day.
Well, there are people, Joe Normal and Susie Normal, that are going to be harmed in the process,
right,
which is the shame.
Yeah, that's the problem.
I mean, the elephants and the donkeys are fighting, but it's the common folk, that can't collect a paycheck, and can't feed themselves, and can't pay the rent. Which is horrible.
That's right, and it is horrible because although some parts of the government are working, it'll soon bleed out that all parts of the government are going to be shut down unless something happens. Unless you do this, this isn't going to happen. And that can't happen in the U.S. because we have 3-4 million government workers that need a paycheck every week to keep the darn thing going.
And tell me there aren't some foreign countries that are watching the fact that the TSA people are not getting paid.
Well, all of this, yeah. You have to show up to work, but we can't pay you.
Yeah.
I don't think that'll last for long.
No.
I
feel a cough coming.
Exactly. Okay, prediction number 3, or is this 4? I think it's 3. I think this is number 3. At the end of the day, the economy is fairly strong right now. So, first quarter of 2019, you will see rates from 4.5% to 5% on a 30-year fixed. You will see real estate prices flatten and not rise. You will see more product on the market and less competition for that house. My prediction is real estate should be good for the next 3 months if you're looking to buy. What do you think about that?
That lending rate is still better than 20 years ago.
Oh, heck yeah. Are you kidding me? If you're going to get a 30-year fix today at 4, and I think on the show, who was it? It was Maggie was saying it's 4.5%, 30-year fix. That's pretty good.
If it stays that way, it's time to jump in the water.
Yeah, I think it is. And I think if you're waiting for the rates to fall again, now I've heard some predictions that actual rates will be cut in 2020. Now that may be because what I was predicting is a recession happening. And anytime you're in a recession, just like we were in 2008, which was more like a depression, the fastest and easiest Kensonian way to get out of any of that is to buy your way out, which is why the federal government prints money and which is why they lower rates, because they want stimulus to happen. And the only real stimulus out there is what the Fed can do.
Yeah, what is the percentage of millionaires and billionaires that got that way through real estate?
All of them, almost?
Yeah.
Pretty much,
Pretty
unless
high.
you're a tech guy. Exactly.
Pretty high.
Thanks for jumping in, Darrell. I really appreciate it. And
My
I
pleasure.
appreciate you who are listening out there. This year should be an interesting year. Stay tuned. We'll try to provide answers and solutions to what you're going to need when you go out there looking for a house. And always, anytime you need us, we are here for you. I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.